Owning real estate is the most common way working class Americans can buy into an investment strategy that can be both satisfying and lucrative. In today's video, we look at the red hot housing market and answer the all important question: is there a crash ahead, or is this the opportunity of a lifetime? It's no secret that if you're buying a home almost anywhere in America, you are likely growing more and more frustrated. Even in historically depressed markets, homes are flying off the shelf hours after being posted and usually going over asking price. Just 5 days ago, Zillow CEO Richard Barton explained what is happening out there in an interview with CNBC. Take a listen.
Joining us now in a CNBC exclusive, Zillow CEO Rich Barton. Rich, thanks for being with us.
Thank you, Morgan.
What are you seeing? We talk so much about inventory shortages, for example. Is that something that's affecting the business? How are you able to, I guess, leverage that dynamic?
Yeah, well, the results that we're seeing are kind of historical looking. So what you're seeing in the homes results right now is the air gap from kind of pausing the plant for a few months during COVID. But if on the forward-looking metrics, the homes business is as big as it's ever been. We've had our biggest quarter in Q4. We bought more homes in Q4 than the previous Q4. So that business is working. It's back and it's ramping really quite quickly. In terms of inventory levels for the housing market, I think that you can get kind of schizophrenic and worked up looking at select headlines about what's going on in the housing market. And one of the shocking ones is historic low inventory. Well, that is actually true. Inventory is historically low, but the real headline is that homes are selling on average in December in 17 days, which is 25 days fewer than they did the December before. So this, homes are flying off the shelves. It's a really high velocity market, and that is what has resulted in the highest home volume sales we've seen in 15 years.
So what is fueling this surge? Well, there are a few explanations out there, but the most common and most apparent is this: mortgage rates. They are currently at all-time lows. Never in US history could you dream of purchasing a home with a 30-year interest rate averaging 2.7%. These historic rates have provided many people to jump into the market that would otherwise be priced out, and according to many, it doesn't look like these rates will jump anytime soon either. The Federal Reserve has made it clear they will keep rates down for as long as possible. Interest rates work like gravity against things like stock prices. Take a listen to this quick Warren Buffett clip.
I mean, it surprised me when you said you didn't think the market was overvalued relative to historical ratios, right?
Well, you've got to crank in interest rates because everything in valuation gets back to interest rate.
And the last time we tried to raise to more normal levels, this happened. The forgotten crash of 2018.
Now is moving back towards the lows of the day. All 30 Dow stocks are now in the red, and the Dow's gains for the year are gone. A distant memory. The S&P 500 has fallen into correction. That's a drop of 10% or more from recent highs. All sectors, and this is key, are in the red at this moment, and the Nasdaq is now at a 7-month low.
To avoid this, lawmakers on both the right and left have advocated for extremely low interest rates, and due to the pandemic and the numerous stimulus packages that have come up, we also have a Federal Reserve that loves printing money to fund its expenses. If you remember a thing or two from high school economics, you know that printing money isn't exactly without consequences. If you do it too much, you end up with something called inflation. And this leads me to the second argument and explanation for the housing market surge. The United States Federal Reserve, led by this guy, has printed so much money in the last 12 months that it would account for a fifth of all US dollars ever created. Essentially, what we're doing from a federal level is diluting the dollar by over 20%. While the government claims that inflation is still in check, many argue that the real number is not being accurately measured or reported. They point to things like housing and commodities as evidence of inflation occurring all around us. Housing prices have indeed jumped, and in this CNBC interview clip with Huntington Bank CEO Brian Sullivan, you can get a sense that things overall are becoming more expensive, and housing is where we're seeing it directly.
Joining us now is John Augustine, Chief Investment Officer at Huntington Private Bank. John, I mean, this is a continuation of what we saw at the end of last year. I know we've got some good news on the vaccines, great news that cases and hospitalizations are down, stimulus is coming, but did you expect the year, even with all that, to really start off like this? Give us a preview. Tell us where your investment team is still seeing some perhaps underpriced assets.
So kind of three areas. You talked about all the areas up in the stock market. Well, there are sectors that are still lagging. There are always going to be individual stocks and sectors providing opportunities. So staple sector, utility sector, industrial sector. Our equity team is looking for opportunities there. So that's three sectors, somewhat that are lagging. We're looking in each one of those for ideas. The second area is the area that's arguably had the most virus management issues now, which is Europe. EFA, that index, MSCI EFA, is lagging quite noticeably. That may be able to make up ground second half of this year. We don't know yet, but it's virus management there. Then the third area to us is Bitcoin has a giant vacuum cleaner out now over gold. So we're actually looking at gold. We use gold and silver in combination for defense, but now that the relationship between the two is getting as such, gold may be an opportunity as this money growth, potential inflation comes at us. So those are three areas, Brian, that we're looking at middle of this year, second half of this year.
So does this combination of inflation plus low interest rates mean that the housing market is a ticking time bomb waiting to crash? Well, according to many, including myself, no. Now, before you comment about COVID, unemployment, and the bubble bursting, hear me out. One of the best ways to get a health check on the housing market is by looking at the delinquency rates for single-family residential mortgages. Right now, we're seeing a clear rise in this stat, but zooming out to previous years, especially 2007, the last crash, you can see that we're likely years away from getting to dangerous levels. Another stat we can check is the supply of houses. Obviously, simple economics also dictate prices. The more of something there is given the constant demand, the less the price of it. Right now, housing supply is extremely low. In fact, some of the lowest levels since the stat began being tracked in 1965. Demand, on the other hand, is predicted to break all kinds of records. Zillow is forecasting a 21.9% annual growth in demand for 2021, the biggest since 1983. There is many reasons to believe that prices will in fact skyrocket, appreciating at a pace that is sure to shatter records. Zillow is forecasting home prices to jump 10% just this year alone, ensuring buyers will have a harder time affording homes, especially first ones. We are also seeing this giant demographic shift in home buying, with millennials finally stepping into the market. Millennials make up the largest generation group in the US with over 72 million members. Experts were often dumbfounded when evaluating models regarding this group, as it seemed like they were not stepping into the housing market. Now, after a 5-year delay, we are seeing a giant surge of buyers. What many don't understand is that if the US is really going to see high levels of inflation in the coming years, buying a home right now is likely one of the best ways to protect yourself against the so-called invisible tax. For every year you have high inflation on long-term low-interest debt, you win. Here's how it works. Let's say today you take out a loan for $200,000 at 2.7% interest for 30 years. In the past 30 years, inflation has averaged around 2.5% in the United States. But let's assume all this money printing will make that average double to 5% a year for the next 30 years. What's that going to do to your mortgage? Well, paying it off in the future will actually be cheaper and easier, since the future value of the US dollar is going to get less and less expensive if indeed we have higher and higher inflation. I'm not sure how much of the market surge right now is people and investors inflation hedging, but you can bet that an artificially low interest rate set by the Feds is sure to promote real estate purchases. Here's me just doing a random search in what is considered one of the most depressed areas of the country. Toledo, Ohio, the armpit of the state. If we just click on a random house selling for $118,000, we can see that according to Zillow's estimates, this house went from being valued $76,000 in 2013 to $118,000 right now in the middle of winter. That's over a 60% price jump. And if you don't believe Zillow's estimate, we can scroll over to the house and price history and see that it sold in 2009 for $97,000. Just another example of how much the market is rallying, even if we consider this is an undesirable market. Thank you guys for watching. Please make sure you hit that subscribe button if you enjoyed.